6% or 6.17% growth is not in itself a cause for alarm. Okay, what is the source of concern? Basically two things. First of all, the fact that the economy, the growth rate has been declining quarter on quarter in an uninterrupted manner since 2010. And second, the fact that some of the key drivers of growth are showing signs of a slowdown and even decline. Now take agriculture. Agricultural growth was just over 4%. Like I said, we went back to 2005 and we've not seen a single quarter in which agriculture grew by less than that amount. Okay, so I'm sure if we go much, much further back, it will be a long time before we find a time where we had such very low rate of growth in agriculture. Part of the reason is that a number of farmers are being displaced because of the violence in the north. Part of it is that, according to the Meteorological Society, rainfall this quarter has been much lower than it was in the corresponding period in 2011. Basically, there's a rainfall problem, and when you consider that last year there was a famine in Niger, it's not totally surprising. And also that perhaps purchasing power of consumers has been affected by the rising price of fuel and input costs. So if agriculture it begins to slow down, we have a big problem. And the only way to reverse this is to recognize that the strategy of bringing more land and labor under cultivation does have limits. We're back to Malthus, aren't we? So you now get to diminishing marginal productivity. We need to start looking at high yield varieties of seeds. We need to start looking at better farming techniques, improved use of technology, irrigation, and less dependence on rainfall. The very things that are included in the agricultural transformation program. So it's important just fast track that. Now the second area of concern is oil. You had negative growth in oil. And that's really because one, a lack of investment because of the delay in PIB, but also a lot of oil that's simply been stolen. We used to suspect it was being stolen. The oil minister has confirmed that it is being stolen, and that last year estimates about $7 billion, and that's the official estimate. So in reality, it could be much more than that. So these are two areas of concern. Now, when this is happening in a time when the world itself is facing a possible double-dip recession, obviously it's a rather gloomy picture. When you consider that just January, we're all a little bit upbeat. Greece seemed to have reached a solution. France and Germany and Europe had reached a fiscal compact. The FSF was going to be expanded. Mario Draghi had provided liquidity to the banks. We thought Europe was over the worst. To think that today we're back to where we were late last year with these dark clouds is a major area of concern.
But if we did see further decline in GDP, what could it mean for monetary policy?
Our instinct as central bank is to keep interest rates as low as we can without jeopardizing inflation. And now, where you have a slowdown in growth and an increase in inflation, obviously our primary mandate is price stability. And we are a price stability central bank. We will not risk inflation going out of control. And we also need to understand the sources of the slowdown in growth. There are times when the solution is not monetary. How do you address low rainfall or political insecurity or theft by reducing the rate of interest? Monetary policy does not address that. So the dilemma we faced was not really a dilemma. It was a dilemma in the sense that you've got rising inflation, which should advise probably some monetary tightening, and a slowdown in growth, which should advise monetary easing. But we do know that easing at this point in time will not address the problems, because we know the cause of the problems, and that's not monetary. Now, easing could create an opportunity for credit to move to other areas in the private sector, but that is subject to progress on the structural side. Banks cannot lend to power plants, they cannot lend to manufacturers, they cannot lend to companies unless they have power, unless they have infrastructure, and those are structural reform issues. They can't even lend extensively to agriculture without progress on the agricultural transformation program. So those are structural policies that have to be put in place before we can actually get credit into the real economy in the manner in which we want to see it. A rise in interest rates, on the other hand, will not do anything. First of all, fuel price and electricity tariffs, these are all structural issues. And secondly, given where lending rates are at the moment, it simply is counterproductive. So we're left with the option of taking a neutral stance. A precipitate lowering of rates at this point in time will simply lead to a further reversal of capital flows. Exchange rate is stable. I mean, people are making a lot of a blip where the rates moved as a result of the euro crisis, but the moment we saw it, we moved in and brought the naira back within the range, and we've shown that we will continue to defend it within that range, and we have the reserves to do it.